In this market, can a normal investor like me just keep buying?
You know what, this seems too crazy. I even got a little pessimistic at point.
Wow, that's new. 3年前我读过一本很火的投资书，叫做《持续买入》，作者 Nick Maggiulli， 华尔街数据分析师，博客写了10年500多篇。那这本书的核心理念就一句话：无论市场发生什么，你要做的就只有持续买入。那过去几年我一直照着做，从没怀疑过。但是现在是2026年的5月，我有点不敢买了。全球股市涨得有点离谱，标普500连创新高，日韩台股同步起飞，光 Nvidia 一家公司的市值就超过了中美之外任何一个国家的 GDP， 这让很多投资者都开始焦虑。那我身边总共有4种人：满仓 AI 翻倍的，怕这是顶；一路加仓的，怕自己是高位接盘的傻子；攒着现金等机会的，越等越觉得错过了；想进场的又被泡沫论吓得不敢动。更让人困惑的是，巴菲特手持历史最高仓位的现金将近4000亿美金，连他都在等，那我们呢？而这本持续买入的方法论今天还管用吗？但是这些问题我找 Nick 聊了聊。
Well, what happens if I go through a bad decade? I've written about it, I have a book on it, and even I went against that because of what was happening. Trust me on this, the math on this is undeniable. Even if he perfectly timed it, I was wrong, and it happens. You know, if I could only give you one line, one piece of investment advice, it would be this. 那因为嘉宾讲英文啊，为了方便大家理解，我制作了详细的章节和时间戳、中英对照字幕和必要的视觉讲解。那这做起来并不容易，所以在开始之前，我想先感谢大家的支持和我的长期赞助商 Interactive Brokers。那 IB 呢是我美股投资使用的唯一券商，因为它功能强大且值得信任，是屡获殊荣的券商。那交易费率可以低到忽略不计，那它的换汇和投资全球市场也都十分的方便。那我在加拿大既然要把加币换成美元，相比加拿大券商动辄 1.5% 的费率来说， IB 的换汇费率简直就是低到几乎可以忽略不计，而且 IB 还会为符合条件账户中的现金支付有竞争力的利息。十分推荐大家点击评论区的链接查看一下 Interactive Brokers， 你点击链接我会有收益，这也算是对我的支持啦。好，那我们就现在回到视频最初的那个问题，在这个疯狂的市场里，一个普通投资者还能持续买入吗？
Depends on your time frame.That's everything. Like if you need the money in the next 5 years, no. I would say absolutely not. You should not be buying right now. If this is a retirement account for 20, 30 years in the future, I would say yes, because the market will surprise you in many ways.
但是紧接着他的另一个回答让我感到有些意外。
A year ago, I was bearish. I'm now bullish once again. Over the last year, because AI seemed so crazy, I got a little bearish for the first time ever, and I reduced my stock exposure by 20%. I went from 100% stocks in my retirement account to 80-20, which to me, that's like being bearish. And at this point now, I'm like, why did I do that?
那为什么连写持续买入的作者都有些犹豫呢？那想要回答这个问题啊，我们得看看2026年这个市场有多特殊。那毫无疑问啊，现在的这个市场全是关于 AI。那关于 AI 有2个争论，第一就是它到底是不是泡沫，第二它到底是不是一个真正的范式转移。
It's probably a bit of both, right? If you look at the history of any large technological change, there's always a ton of players that rush in. There's a lot of capital that goes in. There's always overinvestment. And I guarantee in this case, there's going to be some overinvestment, whether it's already happened, whether it's going to happen in the future. I don't know. Like, we can't predict the future. At the same time, it is a paradigm shift for a lot of things. Anyone that's used, ChatGPT, Claude, Perplexity, you name it. You've seen things like, wow, this can save me time. And there's now bots out there that can do things. And they're not perfect, but they can save a lot of time. It's the question of like the economics haven't, I think, fully worn out yet, right? Because at the end of the day, AI could be just as good as a human, but what if it's more expensive than a human? Of course, everyone thinks the cost of compute is going to keep coming down to the point where it's cheaper than people. And if that's the case, then that's great. But there's a lot of things we have to think through there. It's a very complex question. So overall, I would say, yes, there's overinvestment, but also we know it's a paradigm shift. So it's both. And that's why it's so confusing. If it was an obvious answer, we wouldn't be having this debate right now.
Okay, that's really interesting. You said you turned a little bit bearish. So based on what? Like, is that the earnings or the sentimentals?
Price over sales. There were too many things that just reminded me of 2021. And I think I got a little bit of deja vu. Like, Chamath was coming out with SPACs again. Like, I was seeing price to earnings. I overlaid the Nvidia price to sales with the Microsoft price to sales of 99, and like they matched. Of course, there's a lot of coincidences. I was like, this is just too crazy. Like price to sales, I like that metric more than earnings, because earnings can be manipulated with all sorts of accounting tricks. Sales is like, that's what you have. Like, you have the price of your company and you have your revenue. You can't, to fake sales is like straight up fraud, and people very rarely do that. People can play accounting tricks with earnings. You can't do that with sales. So for me, I was looking at these data series and I was like, this is like, seems crazier than the dot-com bubble. And I think there's just a lot of growth, and that maybe justified it because a lot of that growth has happened. I mean, look at what happened with Anthropic. I think I just read like they were 3 billion ARR, now they're 45 billion ARR in a year. Like that is absurd growth. So the growth is coming, not for every company, but for a lot of them. And so maybe I was too bearish because I just thought the growth expectations were crazy, and they've happened. The growth has come, and so it's interesting whether it'll keep coming. That's a second debate to have, but I think that's why I got bearish because I couldn't imagine a scenario where a company would go from 3 billion ARR to 45 billion in a year or anything even close to that, and they've easily done that. And so that's just an example of the type of stuff that's happening in these markets.
Do you still remember the moment you changed from being bearish to bullish, and why?
I don't think there's one moment. I think it's a slow realization of these things are happening. And like a lot of like I was looking at the data saying, hey, this looks like this is the case. This can't keep going. And then they hit a lot of those targets, right? The earnings keep going up. And like a lot of these things I didn't think were going to happen ended up happening. And so I was wrong. And it happens, you know? That's why for the most part, I just say like it seems so stupid to say this, but like you have to ignore all of the stuff that's coming out and just be like, what does history say? And history says just keep buying. I've written about it, I have a book on it. And even I went against that because of what was happening in a moment, right? And so that's where I think you have to like override your emotions. Now, I didn't do anything crazy. I no matter what, even if this market was even crazier than .com, I would still be buying U.S. stocks. I would just reduce how much I'm buying. And so for me, it's like I'm always buying U.S. stocks. It's just a question of how much. So instead of going, as I said, in my retirement account, instead of going, 100% into, equities, which is like, developed, world, international plus U.S. equities, I said, okay, I'm gonna only do 80% into those. So I just dropped my exposure a little bit and I just kept buying from there. So I always make micro shifts when I get quote bearish, but I'm never bearish enough to be like, oh, I'm selling out all my stocks. I would never do something like that because the data is overwhelmingly positive. You should never do something like that.
OK， 我们聊了这个疯狂的市场以及 Nick 作为一个投资者短暂的犹豫。那现在我们就来聊聊这本书中所倡导的持续买入的底层核心是什么？为什么即使在这个市场里，你也应该持续买入？
The mantra of the book is if I could only give you one line, one piece of investment advice, it would be this: the continual purchase of a diverse set of income producing assets. There's three pillars to that. Continual purchase, you're buying over time, and I show in the data like why this is true. Even if I gave you information about the future, you would have been better off just buying every month, and there's chapters that cover that. The continual purchase of a diverse set, so diversification is at the heart of this, and then of income producing assets. So income producing assets are anything that can produce some sort of income. That includes equities, that includes fixed income, that includes real estate, right? We can go down there. That does not include things like gold, Bitcoin, etc. Does that mean you shouldn't own those? No, but I don't think they should be the vast majority of your portfolio. So if you just take that mantra, the continual purchase of a diverse set of income producing assets, I follow that always. That is always my mantra. Now, the question is, what am I buying, right? So I'm never stopping buying. No matter what happens with US stocks, I might shift from, okay, I'm not buying as much US stocks. I might buy more international stocks, or I might buy more fixed income, or I might shift and buy some real estate. Like the thing is, I never say in the book, you need to only buy US stocks or only buy international stocks or whatever. I don't follow that approach whatsoever. I think you should be buying a diverse basket. And yes, you might change the weights over time based on feelings and things like that. And it's hard to just stick with one strategy for forever. I know everyone says, oh, just never look at it. And if you can do that, great. But I think you will, if you're following markets and stuff, you're going to get a little emotional. So you have to figure out, how do I do this in a way that I'm going to still be successful in the long run, no matter what happens, right? So I might get a little emotional and, as I said, shift from a 100-0 to an 80-20 portfolio, right? I might do a minor shift like that, and then I'll keep buying going forward. So I think that's the framework you need to have as an investor, is like, what can I do so no matter what happens, I'll be okay, right? Because it's not going to be, I think a lot of people think it's like, oh, I'm either going to have 100% stocks or I'm going to have 100% cash. And I think both of those are in my mind are failure. Like you can't have both of those as a mindset. You have to have something in between where if the market rips upward, you're great. And if the market crashes and we go through the Great Depression, you're fine, right? If you were 100% stocks in 1929, you would have been destroyed. If you were 100% cash in 1980, you would have been destroyed over the next 20 years because stocks did so well, right? So just every time period, I can tell you when your portfolio would have failed. The only way to kind of get past that is to have some form of diversification. So that's my approach there.
just keep buying, like for example, S&P 500 index, right? Do you think that's really conviction? I mean, that's pattern recognition. You're just trusting historical data, right? You're trusting what has worked for the last 100 years. So my question is, so how do you build real conviction for the notion of just keep buying itself?
Yeah, no, I understand your point completely. You're like, where does the conviction come from? And I think the conviction doesn't just come from like, okay, we have one country with a century of return. If you haven't read the book Stocks for the Long Run, that's an incredible book. Or Triumph of the Optimist. There's a lot of great books out there that kind of look at different data series, not just the US. And so if you look at a long-term approach across many developed countries that had stock markets, and you look at like how those markets return over very long periods of time, you have a very high conviction rate in the sense of markets are going to probably return about 4% above treasury bills, or 4% above the safe, whatever the safe asset is, right, out there, 4% above cash, let's say. And so 4% may not sound like a lot, but you do that, and remember, inflation adjusted, 4%, you do that over the course of a century, that ends up being a very, very good return. Now, of course, the US has done about 7% above inflation over the long haul. So I'm not expecting 7% going forward. I think a lot of people do. I do not. But if you just stay 4%, I think you can justify that across many different equity markets across the world. And you can do that with real estate, with a lot of different income producing assets. Now, of course, there's risk there. But if you have a diversified portfolio, like you would have done quite well over the last century. And that includes having US stocks, international stocks, having real estate, etc. So that's where this conviction comes from. It comes from diversification. Without diversification, I agree with you. If I just had to pick one stock or one market, I would be a little worried, right? If I said, oh, I'm only going to invest in, Japanese stocks or Korean stocks or Taiwanese stocks, it would be a little worrying. But if I could have something else in the portfolio or other types of assets that give me broader exposure, then I would be far less worried. So I think that's where the conviction comes from. Since at least, the 1800s, since the Industrial Revolution, we've been producing, humans as a whole have been producing more and more and more and more. And I don't think that trend is going to stop. And so that's where the conviction comes from. It's that long-term technological trend, which we keep managing to, hit every single, every few years. We're still on that curve. So if you're going to say that's pattern recognition, well, what isn't pattern recognition? At some point, like everything's pattern recognition. You're looking at a business, you're looking at their balance sheet, and you're recognizing some sort of pattern of the revenue going up, right? So where do we stop that argument, I guess, is my question.
So if you're buying into S&P 500, basically you are buying into the story, the economy, the GDP, the future economy is going up. Basically, you are buying into that story. So that's how I personally get the conviction of buying a broad-based index fund. You are a data guy, and your books are full of it. You've been writing about investing for years now. Beyond the data, what have you actually learned about investor behavior and psychology that surprised you over the last few years?
I think you just realize how difficult it is to get over biases you have. Like, I'm biased against real estate, and I know this because I lived through '08. I lived in an area in Southern California that had one of the worst housing booms in the entire country. I saw prices go from, at the time, a house that was $250,000 got up to about $600,000 within 2 years. That's crazy to see that happen. You don't expect your home to over double in price within a 2-year span. And so I saw that happen. Then I saw it blow up, and I saw people underwater. Like, my own family owed more money on a home that they had than what it was worth, right? So it's called being underwater. The mortgage is larger than the property value after the crash happened. So I saw that too. That's a bias I have. I think in terms of behavioral things, you have to realize what are your biases and how do you overcome them, or how do you try to counteract them, right? So I try to still own real estate despite the fact that I'm kind of biased against it, right? And even like I write about this stuff, I have data, I do all this stuff, and I still, have my moments where I'm like, this feels weird to me, and I make slight changes in my portfolio. So it's like, what do you do to safeguard yourself against your own behavioral biases? What I do is I call it sinning a little, which comes from Clifford Asness. And he's like, if you're going to make a tactical change, AKA go from 100-0 to 80-20, you make a slight change. You don't bet the farm, basically. You don't move everything at once, right? And so for me, it's about making micro changes to my portfolio that allow me to sleep at night and kind of get past some of those behavioral issues without really risking anything for the long. So that's the big one there in terms of a lot of the behavioral things I like to do. But you have to figure out, like, what are your behavioral things? What are those things for you that are causing you problems? And then how do you find ways to trick yourself so that you don't cause a big long-term error from them.
I'll be honest with you. My bias or my preference is buying the dip. During the COVID crash, I have been buying and buying. Over the years, I've become the guys. I don't buy when the market goes crazy. I always buy the dips. What's wrong with that?
The issue is, let's just talk about a market index. We can talk about individual stocks after, but the general issue is if you wait for a dip, a lot of times when that dip finally comes, it's going to be even higher. The price will be higher than where you could have bought previously, right? The story I tell is, I remember back in 2017, there was an investor I knew and he was telling me, oh, I only buy the dip. I'm going to wait till there's a big crash and I'm going to buy. And this was early 2017. So he waited. Finally, COVID happens, 2020, it's been 3 years, right? March 2020, in particular, March 23rd, 2020, which was the absolute bottom. At that point, the market was 33% below its high, right? Even if he perfectly timed it, which of course he doesn't know, is that the bottom? Is it going to keep going? Should I wait? Where do I buy? So putting all that aside, even if he perfectly knew the bottom and bought on March 23rd, 2020, he still would have bought at a higher price than if he had bought back in 2017, like in early 2017. So that's my counter argument is like a lot of times there's a dip. Oh, I got a 5% dip, but you're buying at a 10% higher price than you could have bought before, right? So I think that's the thing people don't go back and say, okay, I'm not buying today on, let's say May, 12th. I'm not buying today, but I'm gonna wait till the next dip and then look. And when you buy the dip, is that price lower than the day you didn't buy? And that's the question. And most people don't do that. They don't write it down. They never check and say, oh, I bought it lower than what I could have bought it at before, right? And if you wait too long, the market can just keep ripping upward. And one last thing on buying the dip, I think you have to realize, and this is why I like using history, the worst dip in, US market history was the Great Depression, right? And do you know what happened? 1929, they talk about the Great Crash and everything. That wasn't even the worst year. The worst year was from 1931 to 1932. The market was already down, I think, like 50% or something. So you're like, oh my God, this is a buying opportunity. From 1931 to the summer of 1932, which was the bottom in, I think, July, the market went down 60%. This is after it already had 2 years of just getting destroyed. So you keep talking about buying the dip, but at some point you may face a dip where it just keeps dipping. Like you could have said, oh, the market's 50% down. I'm going to bet everything I have on this. And then you put all your money in and then you lose 60% on that. And that is truly destructive like nothing else. And so I know we haven't had one of those and I hope we never do. But if we ever come into one of those scenarios, buying the dip can get very scary and can destroy a lot of capital very quickly. And so you just have to be prepared for that. I know that's the worst case scenario, but I need to bring it out because that's what can happen on the downside that people don't really think about.
I want to talk more about cash. Do you think there's a case to be made, like for an individual like me, to have cash besides your emergency fund?
I guess the question is like, well, what's the need for that money? If you're waiting for I'm guessing that you're doing it because you're waiting for a dip, and we've already talked about why that may not be optimal. Now, I understand why certain people like that. I personally don't do that. The reason, once again, I'm holding cash is because I'm trying to buy a house. And so maybe I am trying to time the dip in the real estate market if there's going to be one. I don't know if there's going to be one, but either way, I need to have that cash. If I end up buying at the prices as they are, I still need to have the cash to do it, right? Or I may need to save up so much cash that I put down a larger down payment because of where interest rates are, right? Because if interest rates are 6 or 7%, I don't want to borrow all that money at 7%. I'm willing to borrow a much smaller amount at 7% maybe, but I don't want to borrow, 80% of the value of a property at 7%. That's most of that, if you know anything about how loan payments work on a house, for me, the cash thing is a personal thing. Why would you have cash? My question is just, why would you own cash outside of a need for an actual liability or thing you're going to buy in your life? Outside of that, why would you need, cash? Outside of emergency fund, outside of I need to buy a house, I need to pay for a wedding, something like that, why would you need it? And someone's like, well, I want to wait for a dip or I want to buy a dip. I see the argument, but once again, the data doesn't support it. Most of the time, statistically, most of history, you're going to buy at a higher price. Your cash would have been better deployed in that thing that you wanted to buy already, right? Just buy it now and just take the plunge. Of course, that's scary behaviorally. I understand that.
What's interesting about Warren Buffett is he himself is stock picker, but he advised against individual stocks to normal investors. And you also advise against individual stock investing.
for most retail investors, I think if you're going to pick individual stocks and you want to do it because you enjoy it, it's fun for you, great. Keep it at like 5 to 10% of your portfolio and have at it. Have fun. I'm not against it. I'm just like, you got to reduce your exposure because in the event that you're wrong, it could go very badly. Or obviously, if you're right, it'll do well. But if it's only 5 to 10% of your portfolio, it's like a nice to have, right? I've come up with so many different arguments looking at this. The original argument that most people have heard is what I call the performance argument, which is just like, if you look at professional managers, people that do this for a living, most of them, over a 5-year time period, it's like something like 70 to 80% don't beat their benchmarks. There's something called the SPIVA reports, SPIVA. You can look them up. You can look up at different countries, all this stuff. Most professionals don't beat the benchmark, which is the S&P 500 or whatever their target index market is, right? If it's like the Taiwanese stock market or the Korean, etc. So that was the original argument. It was like, hey, the performance argument. That's why you shouldn't do it. Then I came up with something called the existential argument, which is like, how do you know if you're good at stock picking? You don't like if you and I went to play basketball, anyone watching could tell within 3 minutes who has talent and who doesn't, right? Me versus LeBron James. If LeBron James wasn't famous and we just went on the court, you would know within a minute that he was better than me, right? It wouldn't take you any time. Now, let's say, Ray, you and I went to pick stocks. How long would it take before they knew whether we were good? It could take years. It could take a decade before you know who actually has skill, right? And who's just lucky. So that's my next argument is like, you don't know if you're just lucky or not, right? And that's a problem. And no one wants to look in the mirror and be like, yeah, I just got lucky with that. But that's the case a lot of times. So that's my second argument against stock picking, which is the existential point. And then finally, I think my best argument against it is actually just like, is that the best use of your time? Like, I'm just going to use myself as an example because I don't know your audience as well. I don't know kind of what they do, what their careers are. But like, if you gave me an hour, right? What is the best use of my time in that hour? For me, it's writing something because I could go and I'm going to generate more income from my writing, from writing a blog post, helping to write a book, whatever it is, than I am from researching a stock, right? And putting my money into that. So especially for those people that don't have a lot of money, if you're just starting out, like all that time you're spending, you're going to make far more money by just working a job or doing something that's going to create income. It's going to create you more than your portfolio will. Now, on the flip side, if you have a bunch of money already, then yeah, I think stock research can make you more money because you have a lot of capital at your display, right? I say if you have $1,000 and you get a 10% return, that's $100, which is in the grand scheme of things is not that much money, right? But if you have $1 million portfolio and you get a 10% return, that's $100,000, which for a lot of Americans, that's like a good, decent job in the United States, right? So you can see you could get that return in a year. So the stock research and beating the market and all that only makes sense once you have a ton of money. If you don't really have a lot of money, it makes no sense to waste your time on that, right? So obviously you can't get good unless you spend time researching it. So I get that. But at the same time, like I think most people would be better spent in terms of their financial success if they spent that time on their career than on just trying to pick stocks.
Yeah, I remember in your book you said something like this: savings is for the poor and investments is for the wealthy. The other day I sent a tweet on X. I said people really should focus on their income, especially if you are young, right? And I got this reply. He said, if it were that easy to increase my income, I wouldn't be investing in the stock market. So what does this reply tell you about the mentality of the new investors?
Well, it's not easy. No one said, "Oh yeah, just increase your income. It's the easiest thing." It's not. You can't just hit a button. It's going to increase your income. But like, think about your long-term career and like what you can do to increase your income. And I'll give once again. I can only give my example because I don't know every single person, right? But like in my example, I said, "Hey, I want to start writing. I want to write about something I love. I want to build that craft." For 3 years, I didn't make any money doing this. No, nothing, zilch, right? And then finally, I started running ads on my blog. Then I have book deals. Then I'm starting to do speaking stuff, right? So it's one of those things that, like, I'm not saying that's going to happen for every person, but if you take a long-term approach to your career and you put in enough work, like, you will see some results. I'm not saying you're going to be a household name. I'm not saying you're going to be a famous celebrity. I'm just saying you're going to see something that's going to be, a decent result for all the work you put in. And you have to work at it, and it takes a long time, but like, I've seen this succeed. I've seen a lot of people succeed in this way. It just takes more time than you think, but you have to be diligent about your career. And so you're right. Like if the choices are like, okay, I don't want to put in any effort or I want to just do the stock market, like, yeah, putting in no effort is not going to beat the stock market, but you need to put in some effort to try and boost your career to have more income so then you can actually play the stock market and actually make more money, right? Like in a given day now, if the market's up or down a lot, I'll make more or lose more than I made, in like a really good, half a year when I first started, right? So it's one of those things where as your portfolio gets bigger, the swings on it get so large that it's just like you could end up making so much more money than you ever could have when you first started working. So focus on your career, but then use that to build your investments.
Yeah, I used to share in my channel. I said, you cannot get rich in the stock market before you get rich outside the market. And a lot of people are arguing, like pushing back, like, no, there it seems to be a lot of people are getting rich inside the market. So you're a data guy. Do you have any data on this to share some insights? So is it true? Like there are more and more people are getting rich solely by investing in stocks?
The data overwhelmingly supports a model where people are saving over time and putting it into the market, right? It's their careers. Like if you actually look at like what's the most correlated thing with wealth, it's income. It's not, there's no debate. You can look at every data set. I've actually looked, I did a course for I did just keep buying a course in Taiwan, and I looked at like some Taiwanese like financial data. And if you look at savings rates and incomes, they're positively correlated, which means people with higher incomes save more money. Now, what do I mean save money? They save it and they probably invest it or they buy a property, right? So if savings rates are correlated with income, that means that those people that have higher incomes are going to have more money to invest, right? Every single data set I've seen shows that. Does that mean there's not someone who bought a stock that ended up going up 100x and made money? Of course not. People get lucky. Those types of things happen. And maybe they weren't lucky. Maybe they have really deep skill at identifying these stocks. That's great. But in general, those types of things are quite rare. You don't see those too often. So the most common way people get rich is by either working a job and saving for a long time or starting a business and selling that for a lot of money, right? Or having some sort of equity in a business. Maybe they're on a startup and they get equity and then the business just gets really, really big and they sell that. So one way or another, it's either some sort of equity ownership in a private business or it's working on, a high income career for a long time, right? So that's what the data shows, and I've analyzed that so many different ways. So it's not that you can't get wealthy in the stock market. I guess the question is how wealthy is one, and then two, over what time scale are we talking?
I want to ask you one final question about the market, the current situation. So, what's your opinion on selling and taking profits? Like the market is so high, should people take profits?
I guess my question is, what are you selling for? Once again, this is always going to be an individualized answer. Like, okay, if right now I were to sell, let's say I was forced to sell all my stocks, like what would I do with that money? Like, am I going to go buy a bunch of stuff? Like, no, if I wanted something, I would just go buy it now, right? I don't need to sell something to go buy for no reason, right? So it's like, what are you going to use that money for? If you're like, oh, I need to sell and take profits because I need to go and buy a house or I need to go and fund this thing or pay for a wedding or whatever it is, then yes, taking profits makes sense. If you have a legit real life reason to use the money, do it. But taking profits just to take profits, like I don't always see the point in that. Now, if you're like, well, I'm doing this to diversify, that's a different argument, right? I think taking profits and diversifying can be aligned, but they don't have to be. So before we say, hey, let's take profit, that's a taxable event in a lot of cases. So you have to pay taxes on all that. The question is like, why are you taking profit? Are you taking profit to diversify? Great. Are you taking profit just because? Like, are you going to use it to buy something? Okay. But like, if you don't know why you're doing it, you shouldn't do it. Is my point.
Now let's move on to what to buy and how to buy it. And do you mind sharing with us, like what are you buying? What kind of adjustment you did over the years?
I can just give you like kind of a long-term history of maybe my allocation. So when I started in 2012, I was like 85% equities, 15% US bonds. And so the equities were split. I've always basically been split 50-50 between US stocks and an international. And then even the international split in half between developed and emerging. So it's really like, and that 85% share has shifted over time, right? So that 85% at one point, I was 100-0. I got tired of bonds after like 2 to 3 years. I was 100-0. And I said, wait, why am I doing this? So I added bonds back, right? So I would say right now my portfolio of my investable assets is like probably in, yeah, 85-20, or we'll say 80-20, not 85-15. So it's probably still 80-20. It actually hasn't changed much. Like there's other pieces that have come and gone. I sold gold a long time ago. I bought gold back. Those types of things have happened. But Once again, that's been less than 5% of my portfolio. When you include gold and Bitcoin and art and things like that, those represent like less than 5% of my portfolio. The only other big change, which has nothing to do with investing, is more my personal life, is like I've been buying way more treasury bills. So my cash pile is going up because I'm trying to buy a house. I have a legit reason. I need to pay a down payment. So once again, if we include those assets in my portfolio, my allocation would be more like, 35% bonds and 65% stocks, but I don't know if we should include that because I have a specific need for that, right? So I think a lot of times when we talk about investing, we always say, look, let's just look at all your money and that's your portfolio. But like, if some of that money is set aside for a need, oh, I want to buy a house, I don't know if you would include that in my like risk asset portfolio, right? Or like what my portfolio is going to do in the future. So I think there's different ways to think about this. So if you include my treasury bills, yeah, I'm probably like 35% fixed income, which for someone my age that doesn't, I don't, I'm only 36 years old. I wouldn't necessarily want to be 35% fixed income. But at the same time, until I buy a house. And once I buy one, then yes, I'll go back to probably 80-20. All the rest of those assets will move back once that money's reallocated into a house. So I think that's another piece of this is like, it's really dependent on your life situation, what's going on. Like, my wife and I got married last year. We just had our first child, a few months ago. So it's like one of those things where like, because of changes in my life, my portfolio is changing to reflect that. And this has nothing to do with what I think about the future of markets, or I have more cash than ever because I think AI is going to it's nothing to do with that. It's just my personal situation. I think more investors would do better if they just thought more about like, just what's your actual situation? What do you really need the money for? Most people don't, I think, ask that question, and they just invest based on like, yeah, there's data and all that, but like, what are you actually going to do with the money? If you don't know, there's kind of no point really. Like, the whole point of investing is like I give up consumption now to have more consumption in the future, right? That's the idea, right? So the question is like, what are you giving that up for? What are you using it for? If you never end up using it, what's the point? This is all just for show. It's like monopoly money in that sense.
A lot of my viewers are actually passive investors, so when they hear the notion just keep buying, to them is S&P 500. Let's talk about S&P 500. So it seems like all those AI companies are gonna dominate S&P 500. So if I, as a normal investor, buy into S&P 500, does that put me into a relatively concentrated position? Is not diversified enough?
It depends. I mean, in some ways, yes, it's more tech heavy. And so the question is, do you want to buy an equal weight S&P 5? So instead of S&P 500 market weight, we buy an equal weight. You could do something like that. I think that's fine. If you want to offset that by owning stocks from another country where that country's not as tech heavy, that's fine too. But like tech's a large part of the economy because it's come to dominate a lot of stuff. You went back to the late 1800s, and you would have had a railroad. Like, what was the Dow or you would have had railroads. That was it. That was the economy. It was railroads, right? So it's like this type of stuff happens today. The S&P 500 is still like the most diversified market, even with all that concentration in there. It still has a lot of other things, financials, right? There's all sorts of other sectors in there, energy that matter and it can impact your portfolio. Like I would say in general, most non-US equity markets are more concentrated than the US is because, a lot of times it's like, oh, well, we have this one big company and that big company happens to be in this. It's like in a smaller country. And so it's like, that's our stock market. Your stock market is usually one or two of those companies that just dominate the entire index. So with the US market, at least you have other options, even though, yes, it is getting concentrated, but there's still quite a few non-tech companies in the S&P.
Another concern about S&P 500 is a lot of my viewers, they hold this mantra that they don't go with the herd. It seems like everybody now is buying S&P 500. So first I want to ask you, is that true? And secondly, does that create a problem, like a self-feeding loop? Like, I mean, a lot of people are arguing passive investing itself is creating a bubble and create some risks to the investment market. I want to hear what you think about those.
I mean, this topic has been debated since like started in the 70s, really, but passive didn't really start taking off more until the 90s and even more recently. So yes, is everyone buying the S&P 500? In a lot of ways, at least in the United States, yes. People are buying their 401ks, they have it in their IRAs, they buy it on their brokerage accounts. Like so many people have exposure to this. Is that creating a self-perpetuating loop? Yes, in a lot of ways, but like if every 2 weeks, right? Think about this. We have 401k, which is just like a retirement plan where every 2 weeks when you get paid, some of that money comes out and goes into an investment account. Well, if that investment account has the S&P 500, that means we're always buying the S&P 500. And so there's millions and millions of workers in the United States that are doing this every 2 weeks. So as long as people keep making money and keep buying that, there's going to be a bid there. There's going to be people buying those shares. Now, what's going to undo that? If the economy crashes, people lose their jobs, they stop buying these things, they stop having it. Could that happen? Of course. But once again, that is a very dark scenario. The economy's changed a lot. And like, is that going to undo a lot of the buying power? Yes. Would that cause prices to fall? Yes. But once again, there has to be this huge thing that happens in the economy that causes that. As long as people are still making money, there's still jobs, people are still contributing to their 401k, there's going to be a bid there. Now, whether that distorts prices of other companies, I think is debatable. Like, how would Nvidia have gone from where it was to where it is from passive investing? It didn't. That was active flows that did that, right? People saw that sales went up, earnings went up, and then they bid up the price, right? That's not passive doing that. Passive I didn't say, hey, in my 401k, put more in Nvidia. No one can do that, right? In most 401ks, you cannot do that. So as a result, like, I think active markets are still working. I think price discovery is working quite well. So I don't think that's distorting those things. Maybe it's distorting the market as a whole, but I don't think it's messing with relative prices all that much, in my opinion.
In your book, you said we should just keep buying those income producing assets. And interestingly, you mentioned gold, art, crypto. You had some of those in your portfolios. Probably you still do. What's the reason behind that?
I think these were just hedge assets as like a way of like, hey, I don't know if this is going to be a thing, but I own them as like a hedge. And like, you can look at some of the historical data I've run, like you can run these portfolio optimizers, which is like, hey, given all these asset classes, what was the optimal portfolio, which means like the highest return for level of risk you take. And for example, I ran this back, I think in like 2019 or something, and it was like, you need to have 2% Bitcoin. So I've had 2% Bitcoin in my portfolio ever since. It's the highest return I can get with the least amount of risk I can take, right? And so I've had 2% Bitcoin. Obviously, it's gone up and down. I sold at one point some of it to get back to 2% because it went up too much, and now it's come down. I almost had to buy more because recently, like, the price came down. It didn't get to the point where I needed to get back to 2%, but it got close. And so, I just kind of let it sit there. It doesn't really do much. I haven't done any Bitcoin stuff in a long time. Gold has come and gone. I think with everything that's happened over the last year, we've seen that the dollar dominance is now being questioned in some ways, and so I think that's why the gold run happened. What's going to happen in the future, I don't know. So those are non-income producing, and so once again, those are less than overall. Those are like less than 10%. I'd say about 5% of my portfolio, and art is like basically nothing. I had like it was like 1% of my portfolio at one point. But when you put all that together, like you look at all this stuff, and it's like that's non-income producing. All the stuff I really focus on, once again, is mostly equities. That's going to be US, international. I have like REITs, which is like a real estate exposure because I don't actually have any physical real estate yet. You can do farmland if you want. I have not. I want to at some point. I just haven't gotten around to it yet. I think because of I'm saving to buy a house. I think once I have a house, then I don't want to go and start investing in farmland and I don't have a house yet. I think that's kind of weird to me. So you can do royalty investing. There's so many options out there. I talk about a lot of these things, and obviously I have fixed income, but the main one, I think, if you look at just the record of history, is going to be equities. It's going to be businesses, and that's where most of my money is going to be for the rest of my life.
In this market, is there still a case for individual investors to consider bonds?
Yes, there are definitely there's a case for that. In terms of, I personally recommend short term, so anything with a duration of less than 5 years. I don't like having anything long term because what we saw, I think the best example of this was, the rate increase from 2021 into 2022. Anyone that bought long dated bonds got destroyed because as you know, when rates go up, prices go down and vice versa. So guess what? If you were owning a lot of long dated bonds in 2021, when rates started to shoot up into 22, you got destroyed. So the 60/40 had its worst year ever, I think, in 2022. It's one of those things where you got to just keep your duration short. And the thing that people don't know about ETFs, if you're buying let's say let's say the duration's 10 years, right? When you own the ETF, it's resetting that duration every day or every so often when the bonds mature. You're always in a 10-year duration. It's not like, oh, I buy today and then 10 years from now, my duration's zero and I get all my money back. It's not like an individual bond. You're always resetting your duration. So you're always taking interest rate risk over a 10-year period, which people, I'm not saying you can't do that, but a lot of people don't realize that's what they're doing. And so you don't want to be taking that risk when rates are at all-time lows, because all it takes is a crazy event like that where rates shoot up a ton and then you just get destroyed. So I'm not against bonds. I'm definitely for them, but I'm short duration if I'm ever going to do that. And there's a lot of history on this, at least in the US. The highest, return per unit risk bonds were the 5-year treasuries, right? So anything 5-year or less was the way to go. Once you went beyond 5 years, the risk return just wasn't there.
So recently, I realized that a lot of my friends they start buying options, and they say like, we are long term investors. We are selling calls and get that cash and reinvesting into our stocks. So what's your opinion on using margin, using debt to fund your investment?
The question's always the rate, right? If someone said, "Hey, Nick, you could borrow all this money for no cost," I would do it in a second, right? But it's always about the rate. And if I said, "Hey, I'm going to let you borrow, but the daily interest rate is 100%. I'm coming up with something crazy where the annualized rates, in the tens of thousands, right?" You would say no, right? At the extremes, you can see why it doesn't make sense, right? At 100% daily interest rate, it makes no sense to have debt. At 0%, it makes sense. Where that personal number is for you, that it's going to differ by person. In general, I say don't do it, because the only guarantee from all this is that you're going to owe interest on the debt. That's the only thing I can guarantee. You don't know what your investments are going to do. Those people selling call options, yeah, it looks great now, that money's coming in, but they say it's like picking up nickels in front of a steamroller. One day you're going to miss the nickel and you're going to get run over. And so it's, Taleb has this thing called the turkey problem, where there's a turkey and a farmer has this turkey, and every day he feeds the turkey and the turkey gets fatter, and the turkey starts thinking, wow, these humans love me. Wow, the humans are so great. Every day they bring me more food and I get bigger, and my feathers get nicer every day. And then all of a sudden, on the very last day that the farmer comes with a cleaver and cuts his head off, right? And so you see the confidence of the turkey goes up and then it just falls like that. That's what selling call options is like. You get more confidence. Oh my God, I'm right. I'm a genius. Look at all this money. Look at all this money. And then one day you have this a market event you couldn't have foreseen, and then you lose everything, or lose most of your profits right there. So I'm not saying that happens to every person, but these types of things have happened. You can look up, there's a fund, XIV, Civ. Look up that fund. Look what happened to that fund. That's an example of people picking up pennies. It's just like selling call options, very similar. People are like, oh my gosh, low volatility, this thing's great. As soon as volatility ripped up, where this thing got destroyed and it went bankrupt. So just keep that in mind. Like, it's one of those things, like, understand the turkey problem, understand, how am I investing, and is it like the turkey problem or is it like something else? And so that's where I would caution using debt.
Let's talk about how we should keep buying. You mentioned in the book we're better off the DCA, but when in terms of dollar cost averaging, I find there's a misunderstanding there. What exactly is dollar cost averaging?
The problem is there's actually two different definitions, which is why it's so confusing. So the original definition, which comes from Benjamin Graham, which was Warren Buffett's mentor, is buying over time. You're just buying every time you get paid, you have money, you buy, right? You're buying an individual stock, you're buying an index fund. It doesn't matter what you're buying. You're just buying over time. That is different from the other definition of dollar cost averaging, which is you have a bunch of money today. Let's say you have $100,000 and you say, hey, I'm going to buy $10,000 a month. I'm going to wait, kind of what I call averaging in. You average in, you kind of slowly wade into the market, right? That's also called dollar cost averaging. As you can see, this is quite confusing because they're kind of different, right? One and the other they're very different from each other. They're literally the opposites from each other, which is couldn't be more like, one of them is saying, hey, as soon as you get the money, invest. The other one is saying, hey, when you have the money, slowly buy in. And I'm against the slowly buy in one. I'm and fully support of the one where you buy right away, right? So you could say someone buying in their retirement account every 2 weeks in their 401k is dollar cost averaging. You could also say that someone who sold a business and now is sitting on a lot of money and they're slowly waiting in is also dollar cost averaging. That's where the confusion comes in. Generally, buy quickly, sell slowly. That's my mantra. It makes it much easier. So if you're like, what should I do in this scenario? Buy quickly, sell slowly. That generally makes you the most money. historically in basically every asset class.
I'm not the guy DCA. I'm more of the guy, like averaging in. But I think there's a reason behind it because I do not have a paycheck. I do not have a salary. So I run my own business. Usually the money doesn't come like a steady stream. So that creates a problem. What do you say to people like me who are either freelancers, creators, or runs their own small business? So usually their money comes in a chunk, and that makes it really, really difficult for them to, to DCA because you don't know what happens to your business tomorrow, right?
Yeah, that's a very different scenario because you don't have that consistent flow of money or where hey, I'm going to get paid in 2 weeks. My only slight counter to this, or someone wants to average in, whatever you want to call it, over time, I think that's fine. The question is, how long are you taking to average in? That's the most important variable, right? On average, and this is just what the data shows, if you take 1 year, let's say you have $120,000, and instead of you have two choices, let's just say there's only two choices. You put in 120,000 today, or you put in $10,000 a month for the next 12 months. So by the end of 12 months, you're fully invested. So those are two options, right? Option A, buy now. Option B, you kind of average in. On average, historically in US stocks, the second option, you would have underperformed on average by about 4%. So if you're willing to give up 4% so you don't experience a huge crash right after, that's fine. And I think a lot of people are willing to do that. They're saying, hey, behaviorally, it's okay if I lose 4% of that as long as I don't experience an outcome where the market crashes right away. Okay, that's fine. And you're like, well, Nick, what if I only take 6 months to average in? Okay, then the average loss is 2%, right? You roughly hit half of it, right? So no matter how you look at it, you just have to accept, okay, on average, here's what's probably going to happen. So I can just accept that up front and then make your decision. That's how I would view it. So if you're comfortable saying, hey, I'm willing to take a little bit of a haircut to take 6 months to average in with this money, that's fine. Just don't take 5 years to do it because that's where the performance differences start getting quite large.
Earlier you mentioned you did some adjustment to your buyings. So what's the reason behind I should adjust the frequency or the amount of money I should DCA into the market?
It's up to you, really. Once again, you have to do whatever's going to work for you behaviorally. I can sit here until I'm blue in the face telling you, hey, here's what the data says, whatever. If you don't feel comfortable with it, don't do it. And once again, at the end of the day, is it worth 4% to have not be able to sleep at night? No, just average in. Who cares? You're probably going to lose 4% on average. That's it. It's 4%. It's not the end of the world, right? You'll live. It's not one of those things where it's going to make or break your financial plan. I think a lot of things we get so obsessed. This is called majoring in the minor, where we get so obsessed. And this is not just true in finance. This is true with so many things. We get obsessed with the most minor details that are going to have no real impact on your life. Your life. Remember, your life's up here. Your financial life's one piece of that. We're talking about the smallest detail in one part of your financial life, let alone the rest of your life, your health, your friends, your family. There's so many parts of your life. And we're sitting here and arguing over the most minor detail in one small portion of your life. And I think we miss the big picture. How is that going to affect the entire financial pie? And then how is that going to affect your whole life? Whether you decide to buy now or wait 12 months, it's kind of irrelevant, honestly. I'm not trying to dodge the question because I've done all that. So I spent years doing that, and now I'm zooming out and be like, well, I mean, it was cool, I did it, but I don't see the purpose in these things anymore because it's not going to affect your financial plan. It's not going to have any impact on whether your family loves you, whether you're a good person. It doesn't do anything, right? So it's fun to know, but just pick something and move on. Focus your energy on other things, your health or something else.
People who read your book and followed it have been doing pretty well during the past several years. But when they go on social media, they see other people posting massive gains. I see on my Twitter feeds, okay, this is so easy. This is up $1 million this year. I quit my job because of Nvidia or those semiconductor stocks, right? I 10x'd. So even though your own portfolio is winning, you feel like you're losing because everyone is, seems to be winning more and faster, right? So what do you actually say to that person? So how do you stay sane in a bull market where social media makes it feel like everyone is making more than you? Do you feel that pressure?
No, not at all. I mean, to be honest, not that one. I mean, I feel different types of pressure of different things, but not that one at all because it's the turkey problem disguised as something else. Now, it's not as bad as the turkey problem, but it's kind of like it because it's You have someone who's taking a strategy that might be quite risky, and they're good. They might be doing well now. And if they quit, if they say, "Hey, I'm done. I quit my job. I'm not going to keep risking my money," they're going to probably do fine. But what happens, and you'll see, these people cannot quit. Like I've seen it with crypto. I've read stories of crypto people who are up, 8 figures. They had $10 million. That is a ton of money. Did they sell everything, go into treasury bills, and just live their life off of, what's 4% of that? 400,000? They could live off of $400,000 a year, 4% rule for the rest of their life, never have to worry about it, right? Did they do that? Most did not. They kept playing the game, and then, oh, I'm down 90%. I've seen people round trip up to 7 figures into the millions and then back down. I have a good friend who bought these Solana monkey NFTs. He had 7 of them. He spent, I think, $350, $250, something like that, like literally almost nothing. At one point, he had over $1 million all in after he paid taxes and everything crashed and he sold. He got 90,000. So he still took $300 and turned it into 90,000. Insane, right? That's a lot of money, right? It's not nothing. But he could have had $1 million if he sold the top, but it's hard to know that, right? He didn't know where the top was. He kept going and then he lost a ton. He lost more than he made, right? But he still made a ton. So it's a weird example. These things happen. They're quite rare. Number one, social media, it's quite rare. You're only going to see the winners. It's very rare that people are like, oh my God, look at how much money. Who's going to be like, hey guys, look at how much money I lost? Very rare. It does happen, but it's rare, right? So that's one thing. You're not going to see all the losers, and it kind of biases you. And then two, like, how does it impact like your long term? Once again, what's your long term financial plan? How's that impacting you? Like going and trying these strategies, the only version of success I care about is whether you survive. That's it. You can be like, look, I have way more money than you, Nick. Great, that's fine. If you made that money following a risky strategy, I will say good luck to you, because if you don't quit that strategy, it's very likely in the end you'll end up losing a lot of that money, and then I might end up having more than you. And it's not even about that, but you get my point, right? The only thing that matters is, do you just survive to the end? Can you use your money to live the life you want? That's the ultimate only thing that matters. And so, can you use your money to live the life you want? If so, great. If not, then maybe you need to change your strategy. So I'm living the life I want to live. I think that's what's important to me. Are you doing that for yourself? That's the question I have to the viewer. And so stop worrying about other people, because you don't know what's going to happen to them. You don't know the end. You just know the middle, or like the beginning chapter, or the middle. You don't know the ending of that story yet. And so it's very easy to say, "Oh, I'm doing the wrong thing." You don't know how that's going to turn out. And even if it does turn out a certain way, they could just get lucky. You don't really know. That's the problem with a lot of these things. You don't know the difference between luck and skill in a lot of these areas.
A lot of people saying with market this high, the investors that are in the most awkward position are the new ones who just started. They have this fear that I'm buying into a really, really high market, and the chances is going to be against me in the future.
You're not going to like my answer, but I'm going to say it really doesn't matter that much for the new young investor. And when I say that, I'm assuming the new young investor does not have a lot of money to lose to begin with. Let's be honest. So
Yeah.
it doesn't matter that much. So what do I say to focus on? Focus on your career. You're going to make so much more money if you focus on your career over the long term. What skills can you build? How can you learn to use AI better? Whatever. There's a lot of different careers out there, and there's a lot of different things you can do. Do you want to make content? Do you want to create software? Whatever it is, figure that thing out. That's way more important than what's happening with the market. And you're right. Like, well, what happens if I go through a bad decade? It's better to go through a bad decade at the beginning of your investment career than the end. Trust me, you do not want the bad decade in the last year. You want your best decade to be the last decade you ever invest, when you have the most money to lose. Trust me on this. The math on this is undeniable. You can do, like, if you're putting let's say you put $1,000 a year and the market's going up 5 years, then down 5 years, or you have the market go down for 5 years, then up for 5 years by the same magnitude, it's far better to go down than up. You'll end up with more money, right? And because guess what? By year 5, you have more money invested. You have more money added to the pile. So when you come back up over the next 5 years, you end up making so much more money. So trust me, you want the bad stuff now. So I'd rather be a young investor today than, all else equal, assuming my career was the same, I'd rather be a young investor today than starting in 2012. I'll tell you that much.
One is to focus on their income. Another thing is focusing on learning about investment. If I'm a young starting investor, I don't have a lot of income. I'm focusing on my income, but at the same time, I want to learn about investing. So where should I start?
I mean, you should do whatever type of information that you absorb the best. I personally love reading. I try to read everything. So I would just read, kind of see what interests you, kind of keep reading this stuff. And I understand like, it can feel like you're getting a lot done when you're just consuming information. At some point, you want to actually do something, produce something, whether that's content, whether that's you want to write something, have an investment log. There's a lot of ways you can do this, but at some point you're going to want to start actually producing. It doesn't have to happen right away. You can take a few years. I didn't start writing. I was into investing, since 2012. I didn't start my blog till 2017. So it took me 5 years of me reading and doing all this stuff. When I first started writing, I wasn't that good at it. I got a lot better over time as well. So there's a lot of the act of doing forces you to get better at a lot of things. So that's what I would say.
So how much do you read every day?
I used to read a lot more. I just had a kid, so it's that's not really relevant. Before I had the kid, I read a decent amount. I'd probably say I read about 10 books a year. Nothing that crazy or impressive, like, oh my God, reading 100 books a year. I think my highest I ever did in a year, maybe 25, 30 books. So I wasn't doing super, super crazy volume, but it's not really the volume. It's more about just understanding and just spending time. And I'm not just reading investment books. I read a lot of just nonfiction, non-investment books, because you learn things from biology, from, history, geology, all these different things. There's usually pieces in there that are related to investing in some way or another.
One last question. What do you see in this market, the biggest mistake retail investors are making?
I don't have data on this. I don't know what the mistake is. My guess is people are probably taking too much risk right now, too much undiversified risk. That's my guess. Like, you can own Nvidia and Microsoft and Apple, and you're like, oh, look, I'm diversified, but you really are pretty concentrated in tech. And I know someone said, well, Nick, isn't the S&P 500 concentrated in tech? Yes, it is, but that's even worse. Only individual stocks and a handful of companies, and thinking you're diversified. I don't think it's diversified as people think it is. So that's my counter is, I think in general, retail investors are probably not diversified enough.
Thank you, Nick, for your time, and I look forward to a next conversation with you.
Thank you. Appreciate it. If anyone has questions, feel free to DM me on X, Instagram, LinkedIn, wherever you find me. I'm happy to answer any questions you can. Feel free to just use a translator if you don't speak English. I can translate back. It's all good. Thank you for your time, and thank you for having me on. I truly appreciate it, Ray.
OK， 非常感谢 Nick 接受这个访谈。最后我想跟大家分享个有趣的事儿，就是我是个投资博主，很长一段时间啊，我对我太太说你都应该持续买入，但是最终都是我替她操作，而真正影响她让她行动起来，主动操控自己投资的，就是在她读了这本 Just Keep Buying 之后。所以强烈推荐大家去看一看这本书，以及 Nick 今年推出的新书The Wealth Ladder。 那这2本书也都是我们一口新饭社群过去共同读过的书，对很多饭友都产生很大影响，也欢迎大家加入社群，我们一起阅读，共同成长。感谢收看本次的节目，那我们下次再见，拜拜。